How many of you have heard of Markel before this event? Great. So that means we have a lot that will be encountering this wonderful company for the first time. How many of you are shareholders of Markel? Markel came public in 1990?
86.
In 86. And came public around maybe $20 a share?
$8.
$8 a share. And today it's at about just shy of 1,100.
That is correct.
So it's about maybe a 17% annualized return since then?
I think it's a smidge less than that, but still pretty good.
Okay, and they built their organization on long-term principles of really thinking long-term and acting long-term. So to set this conversation up though, Tom, I'd love it if you would just explain at a high level, almost absurdly high level, what is insurance and what is specialty insurance, and how are those fundamental to Markel?
Sure. Well, thanks so much for the opportunity to be here and meet so many interesting people with the great stories. And frankly, we're jumping ahead, but your great stories and the things you do are the sort of things that we would insure. And if you think about, try to talk about, I'm thinking about the prior presentation and having someone who you don't know have the keys to your house and come in and out. I'd love to hear the story of how they insured that. And we might have been involved because that's the sort of thing we would do. I mean, all of us are familiar as consumers with the major household names, the Geicos, the Progressives, the State Farms, the Allstates, who would insure homes and cars and the standard risk that we would all have. If you think, and I was just kind of writing down some of the things that we do in random fashion. Well, say you were a museum, and I don't know if you have museums in the cities where you live that would have traveling art exhibits. And in Richmond, there's the Virginia Museum that regularly has art exhibits come through that are from other exhibits. Well, that can be millions upon millions upon millions of dollars worth of art that is moving from Boston to Richmond, or from Paris to Richmond, or from Richmond to Minneapolis, or what have you. Well, if you called up the 800 number of Geico and said, hey, I'm gonna move $100 million worth of art, and I think I probably better have some insurance for that, I think they would say, well, that's not the sort of thing we do. That's the sort of thing we do. And just the list can go on and on and on. That's really what specialty means, is that things that other people generally wouldn't do. And so that's a very highbrow example. A different example from the other end of the spectrum would be that we insure bass boats that have too big a motor on it. And if you think about it, I don't know if we have any bass fishermen. That would be a popular sport around here. If you think about a bass boat, typically that's a flat-bottomed boat. And when you buy it at the store, it will come with a 15 or 20 or maybe even a 25 horsepower motor, which is fine for pushing around a flat-bottomed boat. But the really intense bass fishermen who are in the tournament cycles and trying to win and be competitive and whatnot, oftentimes they will take off that 20 horsepower motor and put a 200 horsepower motor on it to get to the other end of the lake faster than somebody else. And typically when that happens, the State Farms, the Geicos, or the Progressives are going to say, that's not our kind of risk. So we would insure risks like that. And then I will tell you, in the early days of joining Markel and trying to understand what they were doing, someone would joke, well, every single accident report reads exactly the same way. Craft traveling at high rate of speed hits submerged object, occupants hurled from the craft. But we would be the insurers who would insure things like that.
And of course,
I know people can't wait to talk to me at the cocktail party afterwards.
And when you write that insurance, obviously the premiums, you're getting the capital, and then you're investing that capital. And some insurers are really don't do much investing in equities. They don't feel qualified. They don't think they have the capabilities. They think it's too much risk. That's not Markel, which has been referred to as a baby Berkshire.
Right.
And so how do you invest? And then both in the public and in the private markets.
Sure.
We'll start.
Well, I mean, you've already mentioned Berkshire, and clearly what Buffett has done at Berkshire has been spectacular, and that's really where perhaps our worlds start to intersect of those of us all in this room, from you running businesses to us investing in businesses. So what Berkshire laid out, and they also did specialty forms of insurance and different forms of insurance that other people wouldn't do, which tends to have higher levels of profitability associated with it. I mean, you're taking more risk. So you have to be compensated fairly for that sort of thing. And what Buffett saw was that an insurance company in and of itself has an investment company embedded in it. And if you thought creatively about what you could do with your investments, you could expand the power of what you were doing. You're doing, instead of a single barrel shotgun, you've got two barrels, the insurance business and the investment business at the same time. So the path that Buffett took at Berkshire for a long period of time was, he had the insurance business, and they started investing in publicly traded companies. And then there came a point in time where, and he tells the story about See's Candy quite a bit, what a transformative transaction that was, not just for the dollars that were involved, but the way it changed the way he thought about things. He started buying privately held businesses. By 1990, Markel went public in 1986. I happened to have been in the investment business in Richmond, Virginia, so I observed it. I knew about Berkshire at that point in time. When I saw Markel go public, I thought, I've seen this movie before. I got to know Steve Markel. He became a client, a friend. I was the analyst for our firm who covered him. He was interested and open-minded about that sort of thinking. So in 1990, Markel did one of its double the size of the company acquisitions. Steve had been handling investments by himself. He wanted a wingman to help him out, asked me if I'd like to join. At that point, I was 28 years old, and really my thought process was, I can be part of building the next Berkshire, and it happens to be located in Richmond, Virginia, where I live, so I didn't have to move. So we've really adopted and used the playbook that Buffett has laid out to run a profitable insurance business, and then take the profits that business creates, build up the profitable investment business on top of that, and through the same path. And it was 2005 before we bought our first industrial business, buying controlling interest in privately held businesses. We called that Markel Ventures as of the moment. And in fact, in the introduction, it was 11,000 employees. That was probably accurate at the time I sent that in. But today it stands at 14,000. We recently concluded an acquisition of a company that makes house plants. This is some very nice plants. I hope they're some of ours here. And we picked up several thousand more employees with that. So we've got 14,000 employees, and in total, that'll be a $2 billion collection of businesses. So it's grown into a substantial thing.
And as co-CEO and the chief investment officer, what are you looking for? Because we hear Ron Shaich articulate beautifully and accurately what's happening in the financial markets. And we're seeing it, we have front row seats to it with so many companies that we're familiar with, brands that maybe are going through a difficult period, that are getting attacked by shareholder activists, private equity firms playing a very short-term game to extract value for themselves. That's pretty unconscious.
Right.
What is the conscious side of finance, and how do you all tell that story?
Right. Well, Charlie Munger says you ultimately will get the shareholders you deserve. So the only thing we have in our control is how we act and what we do. We can't control what's happening externally. We certainly need to be aware of it and plan for it and act accordingly and in response to it. But the only thing we really can control is our own actions. So the first answer, and the first part of the question, is the sense that in the face of the financial market conditions and the activists, what can we do? Well, one of the proposals listed there was to not have earnings guidance. We haven't had earnings guidance in 30 years. We've never done it. We've never gone down that path. We've not split the stock. So in addition to the business growing and the value growing, as the stock went from $8 to over $1,000, all the way along the way, people would have said, well, why don't you split the stock? Well, splitting the stock would have increased trading, but the increase in trading would have decreased the intensity of ownership. Exactly the turnover that he speaks of. So generally speaking, if somebody has a share of Markel that they paid $8 for and now it's worth $1,000, I like to think that they're going to hold on to that pretty tightly and be reluctant to trade it and think of it as a stock, but more as a partial ownership in a business. We have direct conversations with our important shareholders, have for years and years and years. This is nothing new. This is the way we've always designed it and always tried to do it. 10 years ago, I would have told you that if you looked at the list of the top 20 shareholders, I would have known 16 of them, and the 4 that I didn't know, I would know at some point, get to know. You yourself as an example, we've spent time together in Richmond, we've spent time in Alexandria, so I know who you are. I've known your uncle and your aunt for 30 years, so there are those relationships that exist. In today's world, out of our top 20 shareholders, I would say I know in that way 10 of them. 4 of them are new, so I don't know them yet, but 6 of them are computers. And we're probably really not going to chat or develop much of a relationship. So yes, the structure and nature of markets has changed, but I would also say there's some cyclicality to that. So I would be unwilling to make permanent changes in the business and sever things for cyclical reasons. But many of the ideas that Ron spoke of, I agree with, and we have tried our best to incorporate some of those in the way that we've done things. So one aspect of your question. The other thing, what do we look for? So the businesses you're looking for, the stocks you buy, there's really 4 themes that I would talk about. One is we want profitable businesses with good returns on capital that don't use too much debt to do it. And that seems so motherhood and apple pie that it's hardly worth saying. But in keeping with you all running businesses and knowing what it takes, that profitable business aspect, I view profitable business in the sense of conscious capitalism as a social stamp that you are doing something that people want and they care about, and you're good enough at it that you can do that and still enjoy a margin of profitability for yourself. So if I see a business that's not profitable, and I understand cyclicality, and I know all businesses can go through seasons when they might be more or less profitable, but if there's not any history or consistency or a long-term profits, that tells me that either you're doing something the world doesn't really care that much about. I mean, you may have some passion about, I don't know, garnet contact lenses. So you've built the best garnet contact lens that exists on planet Earth, but how many people are going to buy that? So it's a limited audience, so that, you can have that sort of thing. Or if you're doing something that obviously people want, you're making cars. A lot of people have cars, let's say, but you're consistently unprofitable. Well, there are other people who are doing it who are consistently profitable. So we live in a competitive world where you do have to compete for resources. You're not as talented as you need to be to survive. So I look at that long-term profitability as really society is stamping you and saying, thank you. Profits equal thank you. Thank you for doing what you do. And thank you for doing it well enough that I'm going to voluntarily transact with you and do business with you and keep you in business because I want to do business with you tomorrow and the next day and the next month and the next year. The point about not too much debt, I think, is very important. And I agree with Ron's comments about the way you choose to finance yourself is critically important because if you use debt, that's a ticking time bomb. There will come a time when that debt matures, that debt is due. There's somebody who wants to be paid. Contractually, they're entitled to payment. And if you're in a bad season or something where you can't finance things, or you might be fine, but if you go through an 08 or 09 when capital markets just shut down, you might be doing everything right. But if your capital structure causes you to have the hands ripped, the cards ripped out of your hand while you're in the middle of the hand, that doesn't do you any good. So as a risk management, I sort of stay away from debt. I also think of too much debt as something of a character marker. So I like people who don't use a whole lot of debt. There's just a fundamental conservatism about them that is more comfortable to me. If you're looking at people who use a lot of debt, well, they're playing a different game, and they're rolling dice, and they're smarter, faster, stronger than I am, but I don't want to play that game. So,
and I know your second principle is also a Berkshire-like principle, and Michael Shern, who invited you to be here with us, and if you haven't had a chance to talk to Michael or to Tom, I hope you will this evening, both great investors and great investment thinkers, is a qualitative factor about the quality of management, the ethics, and the commitment and passion of leadership.
Correct, and I say managers who have equal measures of talent and integrity, because one without the other is worthless. If you have integrity but no talent, you may be a very nice person. I may like you very much. You may be a great neighbor. But in the context of business, you can't get the job done. So that really doesn't do us any good. If you have a lot of talent, but you don't have integrity, that's not going to end well for me. So to have a true partnership that lasts, that both people benefit from, integrity has to be a fundamental building block of that. So we do spend time and think about it.
How do you determine that?
Well, I think about it. So we did some show of hands on who's heard of Markel or who's a shareholder. I'll ask for a show of hands. How many people in this room are married? And I am. Okay. A lot of you. How did you decide who you're going to marry? You dated. And the point of dating is not really to see that movie or that ball game or eat that meal or whatever. The point of dating is to understand whether you share values and core aspects of yourself that overlap enough so that you won't drive each other nuts over time. And so a dating process is basically a qualitative attempt to figure out whether you're compatible with somebody. So we spend time with managements. Sometimes it's actual physical content. Certainly in buying a private business, we would spend time with the management to try to understand their story and how it came to be. We're going on dates to see if there's fundamental compatibility.
When you typically buy a private company and buy a controlling stake, is the leadership team, do they remain intact and run that business in all cases, in most cases?
In all cases, yes. We've bought 16 businesses, and 16 out of the 16 management teams came with it. If I'm buying it, I never buy something with the idea that I'm going to change management, because they know how to run that business, not me, and I need them. Now, of the 16 companies we've bought in the past 12 years, 13 of the original CEOs are still in place today. So I think that's a pretty good batting average, number one. One of the three changes was a planned retirement. The sale was a phased process by which the founder could retire and turn it over to the next generation. And two were things maybe that didn't work out quite so well. And I'm not perfect, I make mistakes. But generally speaking, if you see CEO turnover in a business we bought, that means I made a mistake. I accept responsibility.
What do you think about that in the context of hearing about Buffalo Wild Wings? Sally Smith runs the business from the private markets into the public markets. In the public markets, I think during her tenure, it was maybe around a 15-bagger. And then she's booted out by a group that's obviously extractive in their approach to business, self-interested, and already we see the valuation of the company down 30 to 35%. So that's like exactly the opposite of the Markel acquisition process of purchasing something because you believe in what's happening and you want to support and encourage that group that's growing that venture.
Correct. And it sounds like a tragedy. I'm not intimately familiar with the facts, but in what you just said and what was talked about earlier here today, that's a tragedy. There's no other word for it. And it is a feature of today's financial markets that I don't know how to fix it. And I can't change it myself. The only thing I can do is change how we behave in order to try to have the best possible odds that will not happen to us. And one of the key factors, and I understand the Panera story and don't disagree, everybody has different weightings and how they decide things. One of the things we joke, because we have such long-term time horizon, because there were 3 generations of the Markel family that ran that business before my partner Richie and I became the CEOs of the business. We joke that we are a private company that happens to be publicly traded. And the good news about that is that, all right, for instance, when I was a 28-year-old kid joining the company in 1990, I was able to buy some stock. I was able to get some equity in the company on day one because it was publicly available. And there was no negotiation, no intrigue, no nothing. It's, hey, there's the stock, you got a broker, don't you? Buy some. So the mentality of the company that enabled non-family members to come in and acquire equity ownership, and in most cases, I own the vast majority of every share I've ever bought, I still have. But I do have 3 children who I have put through school and 2 out of 3 weddings so far, 1 more this year. So I have sold a little bit of stock along the way because I needed a little bit of money to live. But I've managed to hold on to the vast majority of everything that I've ever gotten. So that liquidity and being able to have new people come into the organization, have people in a 14,000 person organization where people are going to retire, to be able to get liquidity at that point without disrupting the operations of the business. That's a good thing about public companies. So
But you would suggest that great public companies try and do whatever they can to be able to run themselves like a private company in the public markets while fulfilling the responsibilities that you have to external shareholders in communication, sharing information, disclosure, but the actual principles of running the company should be built around almost a private controlled business.
Absolutely, absolutely. So walking around the halls of our business and visiting our operations, this is a phrase that has rolled off my lips a bazillion times. So somebody will say something to me, we're thinking about this, or we're doing that, or what should we do? And I say, well, let me ask you this. If this was your money, and it was the only money you and your family had or were ever going to have, what would you do? And generally speaking, that tends to frame things reasonably well to get to a good decision and an action point of what you should do right now. Now, that is a qualitative way of saying it. You can also say that quantitatively, in that what is the net present? I mean, if you really wanted to geek out, and one of my three children, I call her my 4 decimal point child, because answers like that were deeply unsatisfying to her. She likes the spreadsheet and is a data ninja and distills things down to numeric side. You can say, what's the net present value of that decision? Well, in the accounting statements, this quarter or this year, that can look like a bad decision because it can incur period accounting costs. But in the long run, even the accounting gets it right in the fullness of time. And one of the things we would do to support that institutionally is if you look at, and Ron spoke about, management compensation systems and how that should work. Personally, I get paid over a 5-year rolling average. And I don't think there's a whole lot of CEOs who have that kind of time frame that sets their year-by-year compensation. And I joke, in these 5 years of his discussion, how he came about it, I always tell people, look, if I get fired, the next job I wish is to be a maker of 12-year-old Scotch whiskey, so that it's at least 11 3/4 years before anybody knows if I know what I'm doing or not. So we haven't quite gotten to that ideal, but I think as a practical matter, the 5-year rolling average has been very helpful. And if we started that today and we had no history, that would be tough. But by virtue of the fact that we've been doing that for 30 years, that is helpful. And it sounds like part of the tragedy for Buffalo Wild Wings, and we'll stipulate that that's the case, is unfortunately, that had been a public company, 5 years or 3 years or 7 years, whatever?
A longer, let's say it came public, I think, in 15.
15 years. Well, that's
2002.
Again, I have no other word for it than it's, it's a tragedy.
Let me ask you, you said, and I like your answer, I'm having fun challenging it, I'm not really on the attack here. You said the best thing I can do is I don't know how to change that other than to behave the way we behave and get better and demonstrate and show people how much value can be created when you think this way. But has Markel, through Markel Ventures, or in your investment work in the public markets, do you connect with other investors like you? In other words, is there a network that you're connected with, and could that network continue to grow? Is there a possibility of a conscious network of capital access for an entrepreneur starting a business all the way through to a public company that's going through a difficult period and needs some help fighting off an activist?
Yeah, I would choose, it's an element of discipline, to be pretty optimistic about that. And you're part of the answer, and the crew that you've assembled at Motley Fool and your subscribers, and the way in which you talk about, shares are a share of a business, and you talk about the business, not the trading stories, that is helpful in the process. I think what we do is helpful. It's a role model. It's part of the process. I think there are other companies that also behave well and do well. There's a lot of them that set a good example, and it is a counterexample. It tends to be quieter. So what you do and what I do tend not to be the leading stories on the network news or the financial talk shows or financial magazines. And that's probably a good thing. Generally speaking, we would not, it would not be something good happening if we get a lot of coverage. So just quietly going about your business in and of itself provides a forum, it provides an example, and it provides a network. And certainly in the case of Markel, I know you've seen it, but for instance, the first shareholder meeting we ever did out in Omaha around sort of the events of Berkshire. We had 6 people. We've done that every year since then. Last year we probably had 1,200 people. So the majority of Markel stock was in that room at that particular time. And we've done it every single year. So that's a network. And those people, and this is another reason that you want to fight for being a public company, and you hope that the public company model and example works well, is because those networks, those people in that room, the people in this room, the relationships that you build, in almost every single case of every good idea we've had, whether it was a good company to buy stock in as a public company, whether it was a private company that came to us, it was suggested to us by someone in that network. The referral, the word of mouth, the reputation that just starts to snowball over time. You need to be a little public in order for people to know. So I imagine when you got your listings and you saw this company, Markel, was going to be talking, some of you might have said Markel. So not only have you not heard of it, you didn't know how to pronounce it. So it's Markel. We've learned that much today. But you need a public forum, and you need some public communication in order for that to happen.
And does your decision to come here to Conscious Capitalism via Michael's invitation mean that Markel has viewed itself and demonstrated these principles as a conscious company that's interested in how other conscious businesses and investors are thinking and what they're creating going forward?
Yeah, absolutely. And I joke, I grew up in the Delaware Valley. And the Delaware Valley in Philadelphia was where the Quakers first came to America. And the old joke about, Philadelphia, if you've been around the Delaware Valley and that kind of stuff, is the Quakers came to America to do good, and they did well. So they were noted as business people. So that effect of serving people. I mean, that's the heart of business, is you are serving other people. And that's one of the things, with our 14,000 employees and 16 different industrial companies and insurance companies, basically every single business, every single meeting, every single thing that I'm involved with or touch or feel here is where a customer has a problem or a situation or a need of some sort. And we turn ourselves inside out trying to figure out how to serve them. That's what we do. And it's worked extraordinarily well. I mean, you saw it on the per share price. When I joined Markel in the early days, I think the total balance sheet was $75 million. Maybe the total revenues were $50 million. These are numbers that you can identify with. We'll do $6 billion worth of revenues this year. We have a balance sheet of $25 billion. We have shareholders' equity of $10 billion. We have a market cap of $14-15 billion. I mean, that kind of adds up. But all of that has been accomplished one by one of having a relationship with somebody who needed something, some help with something. And we said, well, I think we can figure that out. We can come up with what you need. And they voluntarily, through voluntary exchange, choose to do business with us. And in so doing, they solved their problem. And we came to do good, and we did well.
My final question, because we're almost out of time, and then I want to just end with a little reflection on this conversation. But the great the presentations this afternoon, just extraordinary. Having come to Conscious Capitalism for so many years, I was just blown away again here this afternoon. The technological, the 1, 2, 4. 8, 16, 32, right. 64 exponential growth that our minds are just not wired to understand. What are the implications, do you think, for insurance, or even if you want to go more broadly, for finance and investing? I mean, do you expect that virtually all investing or insurance writing could be automated with the algorithms and formulas that are being created, the situations of the patterns of finding a great specialty insurance situation all the way to finding a great company to invest in? Can that all just be put into a set of formulas?
I'm reluctant to say all, but I will say that each and every day it's more. So, it's like the concept of half-life. And how fast does this uranium deteriorate? What's the half-life of this? Well, you had a measurement period too where you got to half. Well, it's still half there. Then there's another measurement period, so that it keeps moving. But for instance, I think about this in the context. So the comment was made about DNA and genetics and the improvements there. Well, if you think about health insurance as a discussion topic, and we are not in the health insurance business, but just thinking about this theoretically. You know, insurance is a pool of money. So I don't know what's going to happen to you. But in aggregate, I can take the number of people that are in this room and I can say, okay, we're going to spend on aggregate $20,000 per person for our healthcare expenditures this year. And I can do that math. It's a simple multiplication. I just don't know who has what disease or issue. With analytics and knowing more about genetics and sensors and wearable stuff and the internet theme, I know you'll be fine. And you know.
Where was you pointing on the second one?
Yeah, well.
Me? Did you point at me?
Yeah. So one time after one too many hours at a convention, somebody said my check liver light just went on. So, you know, you'll know that before it happens. So the aggregation of data, which is a fundamental aspect of risk sharing, that can and will change dramatically. But there's probably still some mutuality, some coming together, some socialization of those risks that we'll figure it out each and every day as those circumstances present themselves.
Michael asked that I not mention him, but I've now mentioned him two, or now a third time. I also want to mention my brother, because he's done this, and I've only done it once with Salim Basul, the CEO of Middleby. People, those of us who invite people into the network, that's one of the biggest ways that we start to get exponential growth in this thinking out in the world. That's how we're going to change business, finance, investing, entrepreneurship, and getting the organizations that are really serving all their stakeholders and just getting that mindset going. So I want to celebrate Michael for asking Tom to visit, even though, as Tom said, we've known each other so long. I had not invited you, and what a great person to add to our network as a super long-term thinker with capital on the balance sheet, looking for great organizations to be a part of. So thank you so much for coming. And,
thank you.
And right on. Right on.
Thank you.
Yeah.